Welcome to the Commerce Lab, where every week we sit down with top performing consumer brands and leaders to understand what drives their success. How did they hit their first million, their first 20 million, their first 100 million? What strategies are working for them today that you should be testing, and what's not working that you should be avoiding? This isn't just a podcast, it's the business school for brand operators. Hey crew, it's Alan Burt. Welcome back to another episode of the Commerce Lab. And today we are going to go behind the scenes of a DTC or direct to consumer holding company. And my guest today is a guy by the name of Kyle Widrick. Kyle is the founder and CEO of Win Brands Group, which is a direct-to-consumer holding company that has acquired brands like Homesick Candles, Stowaway Cosmetics, amongst others. I believe they're up to about 4 brands now. And I brought Kyle on the show today because I'm fascinated by this concept. We're seeing brands like Casper, trying to go public, releasing their S1. We're seeing sort of this market that is direct-to-consumer brands starting to mature, and people are starting to ask the questions: what happens next? What do these brands do? Do they all go public? Do they get bought? Do they maintain profitability and continue to operate? And so I wanted to bring Kyle on to understand a little bit how he thinks about these brands. And more specifically, what does he look for when he's acquiring brands for his holding company? And so we break down things like product price point, AOV, what's the optimal AOV range that he looks for in a brand? Velocity, how fast are they growing? What level of revenue, what sort of a minimum revenue level they need to be at before it's even an attractive brand for him to go out and buy. Also, what's their secret sauce, right? So if they're acquiring a brand, he's doing it with the idea that he's going to be able to interject his team or his knowledge or his abilities and actually then grow it. So what is that? What is that secret sauce? Who are the people that he employs and actually can then inject into a brand to help grow? We also touch on valuations, right? We've seen a lot of brands in the past have raised a ton of money based on really sky-high valuations. How does he think about valuing brands today? By multiples of revenue, multiples of EBIT, whatever it may be. And then finally, if you've ever thought about selling your business, right? Or you've ever thought about actually going out and buying a brand, this is a fantastic episode that breaks down the components that you need to be considering, right? We talk about the businesses that he's personally bought with Win. We talk about their AOV. We talk about their gross margins. We talk about what are they aiming for year over year growth. Or we really dig into the weeds. And so again, if you ever have any interest in buying a brand or selling your own company, this is a must-listen episode that's jam-packed with insights from Kyle. So without further ado, let's just jump right into it and let Kyle from Win Brands Group take over. Hey, Kyle, welcome to the show.
Alan, great to be here. Thank you.
Yeah, man, I'm pumped to do this interview, and for a couple of reasons. First off, I think what you guys are doing, it's a little bit different than what we've typically done on the podcast. We're not speaking to just like a single brand owner or a single brand operator. And what you guys are doing over at Win Brands Group is, I'll let you describe it, but you guys are obviously more of like a PE holding company style model. So I'm really excited to kind of dig into that as well as dig into some of the brands. But before we do, why don't we give everybody just a little bit of background about who you are and let you tell everybody what you guys do at Win Group.
Sure. So Kyle Widrick, CEO, founder, Win Brands Group. And what we're doing is really building a community of special brands. We partner with companies that have created amazing special product that are out on the marketplace. And our focus is actually acquiring a majority of that business. And then we have a shared service team here at Win of people that we've hired from Shopify, Wayfair, IAC, Red Antler, really talented people who then help to run these businesses from a portfolio approach. So the idea would be, over a period of the next 3 to 4 to 5 years, we will have a couple dozen brands that are all operating as part of this shared service. You could call it a D2C holding company. And all the brands doing better with this support and our support behind them. That's the idea.
Okay. So there's a ton in there that I want to unpack. And so we'll sort of do it, one at a time here. And I think the conversation and what you guys are doing is very timely because we're seeing, we're recording this in sort of an early 2020, in January 2020. And, I think we're seeing some interesting things happen, right? Like Casper's IPO, we're starting to get some background on some of these extremely well-funded D2C brands that were early stage that are now sort of exposing their financials to go public. And we're seeing kind of what the costs are to scale to the level that they're scaling to. And so I think there's a lot of people in the space that are wondering, okay, what happens, right? As you scale a consumer-facing brand, utilizing this sort of D2C model, quote unquote D2C, what do you do? What are your options, right? Do you sell? Do you go public? Do you sell to a PE firm? Do you just hold and remain profitable, right? So I think we can kind of unpack kind of how you guys operate and how you guys think about scaling, but then also I'd love to get your insights on what you think about, how you think about the industry and where it's trending. So I think the way I'll start is when you guys are looking to acquire brands, and I think to date you've acquired 4, is that right? Or 5?
Yes, 4 to date.
4 to date. Okay. When you're looking for a brand, what specifically are you looking for? Like what attributes, what level of revenue, level of profitability, what are sort of those, what's the framework you're looking for before you make an acquisition?
Sure. Yeah, I think part of this, we'll probably get to this later, but my background is both consumer investing and then agency. So there's a lot of learnings there that dictate, my lens as to how I look at this space and look at these brands. But on the surface, we look for a company that has shown product market fit and some level of justifiable revenue. So as an arbitrary kind of minimum, we look at $5 million in revenue. That means you've done something right. You have a product that is at least in some way resonating with, the customer. We also look for, what we call special brands, brands that we would see around or would expect to be around over the next 10 years. There's something special and unique about that product and about that brand. And then for us, we are uniquely suited to better commercialize product brands that are not super expensive. So we look at product price point that is sub $100 from an AOV perspective. And has the ability to sell really across channels. So what I mean by that is, we are experts based on our background in direct commerce on the .com and primarily on Shopify. But we also believe that if these brands and these products are working, they can also work on Amazon, which we sell a lot of products on Amazon. They can work at retail wholesale. We have partners there, including Saks, Macy's, Bloomingdale's, Target, Dick's, etc. And then also platforms that have popped up in the last few years, like Faire, where we can sell product to a lot of mom and pop merchants. So really, companies that are working, companies that have shown some size. We are not an incubator. We don't start businesses. We look for businesses that have taken off and that can really use some of our operational and financial support to get to the next level.
And when you say brands that have taken off, is that purely on a revenue standpoint? Do you measure it purely by revenue? You say that 5 million revenue mark? Yeah,
listen, that's the arbitrary kind of initial hurdle. Obviously, momentum matters. Did you go from 0 to 2 to 5? Or were you 5 a few years ago and now you're at 2 or 1, right? So that trajectory matters a lot, and that does factor into our decision. But I've also seen brands that had an amazing, trajectory out of the gate, and then something operationally got in their way. A 3PL shipping logistics issue as one example, that really crippled their growth. So absent of that, they might have had a much different trajectory. So if we could plug into that and really, fix those problems, all of a sudden we're back to being a very good and healthy business overnight.
And you mentioned the sub $100 level. Maybe go into a little more detail on why product AOV at sub $100 makes sense for you guys.
Yeah, listen, I think for other groups, other people, high-end fashion, trend-driven fashion, there's plenty of people that make a tremendous amount of money selling those products. For us, we look for more obvious commercial products. If you look at our portfolio, we have brands like Homesick Candles, which happens to be a candle brand, but really what it's selling is that sense of emotion and that sense of nostalgia about being home, right? So that translates to a lot of different areas. The price point is $29.95, not a super expensive item to either pick up for yourself or a friend as a gift. And the same thing with Kalo. They were a category leader when they launched. And we liked the fact that they had positioned themselves around sports and active lifestyle. But again, it's a price point at $30 that really is attainable by everyone. And that allows us to really commercialize it on a mass scale.
And when you say commercialize it on a mass scale, maybe what do you mean by that?
Yeah, really, it all comes back to cross-channel sales growth, right? So, I could make an argument that I could grow a tremendous business in $800 rain jackets at retail because I have relationships at Saks and Bloomingdale's, right? But that same jacket is going to be really challenging for me to sell direct, just based on my experience of direct customer acquisition. It's also probably going to be really challenging for me to sell on Amazon, right? Just based on price competitiveness. So for me, if I can pick up a product that has some brand cachet, but that is also relatively inexpensive, I can actually do well across all of those channels of growth. That makes sense.
That makes total sense. I think and that's why I was curious, because I think you would hear the alternative argument by a lot of folks that would say, AOV under 100, the challenge then becomes with performance marketing, right? And selling to direct, through your own store channels. It really limits the ability to, create a high return on ad spend if part of your scale playbook is aggressively pushing performance marketing, right?
Yeah, listen, I think obviously you have a lot of smart listeners on your podcast. For us, we try to focus on being first acquisition cost profitable, right? So on first time purchase. We also believe that we are not trying to scale these businesses to be billion-dollar businesses. If we have a $10 million top line business or a $25 million top line business, we do target a $50 million overall revenue for these brands, but we're very comfortable running them profitably at, 10 million in revenue. So we're not trying to aggressively scale by losing money on any one direct channel. We actually look at each channel and the relative contribution, and we really try to maintain positive contribution across all channels at all times.
Do you believe, and so I think this goes a little bit to the model and the way that you've set up the business. Is that because you believe there's really like a revenue ceiling for a lot of these brands? Or maybe explain to me the philosophy of, okay, so let's dive into that. What do you think the ceiling is? Yeah. And why do you think there's a ceiling?
Yeah, I mean, listen, if you go back to V1.0 of e-commerce, for those of us that are old enough, which I qualify for that, you have Bonobos, right? And when Bonobos launched, I think the idea was that it was infinitely scalable, right? Customer acquisition, online, this thing's going to go to the moon, billion-dollar business, online direct. If you play that forward now 10 years, you obviously see that, online direct is just another channel, right? And that channel gets more competitive as you try to broaden that funnel. So it depends on the product. It depends on the price. I think the ability to penetrate media has gotten a lot harder because you have a lot of smaller media channels and kind of mini tribes that you need to actually tap into to get that profitable contribution. So it takes a lot of time and a lot of focus to be patient enough to actually broaden the funnel on a profitable approach. And I think for us, that's the challenge. And that's part of the reason why I focus on M&A. If I'm able to come in and partner and buy a company that's doing 25 million in revenue, effectively I'm buying myself years of time that I can leapfrog on the base that they built and the customers that they already have. And then I can just focus on growth and being more efficient on a channel basis moving forward.
And so when you're looking at these brands to go in and acquire sort of leapfrog, are you looking at sort of founding teams? Are you looking at leadership that's currently within the brands? Or are you really looking at from a product brand positioning in the market standpoint? And are you guys replacing leadership teams?
Yeah, mainly product first. So you got to believe that this is a special product and a special brand that's going to be out there in 10 years. I like to say that it's a really sad world where it's only Amazon, Walmart, and the dollar store.
Right.
There has to be other brands out there. Consumers love these brands. However, it's really hard. Anyone that's run a brand knows, getting from 5 to 10 to 50, that's great. But a $50 million business is actually just a lot more pressure on your shoulders unless you've raised a ton of money, right? If you're not super profitable or haven't raised a ton of money, it doesn't necessarily get easier. It actually can just start to become more pressure. So we look for special products that we believe we can do better with. Then we meet with the management. We try to understand their priorities moving forward. And if we can make the case that by partnering with us, we can both grow the asset larger than they could on their own and ultimately likely exit the business faster, then that's a good partnership, right? And then we decide what the pricing looks like, how we can come in. The one sticking point for us is we do require that we buy a majority of the platform. And that's mainly only because, from a holdco perspective, the way we're structured, we end up rolling up the revenue from all the brands and ultimately reporting from a holdco basis. If we have 10 brands all rolling up into the holdco, that's how we reflect our total revenue.
No, it makes total sense. So, and you kind of already dipped your toe into this. So I'm going to keep going this direction, talking about deal financing. So you guys require majority ownership as part of the deal structure. How much of the the buyout or how much of the investment, however you describe it, is going towards sort of a payoff to original founders versus how much is going towards an actual cash infusion to grow the business?
Yes, we look at both. So it really depends. You get all sorts of cases. You get two founders who own 100% of the business. You get two founders who own 60%, and then they have 10 other investors that are in. It really depends who's there. What I try to make the case on is, take a portion of that cap table and replace that with us and my team of, call it 20 people that are here, that have done it, that have done creative at Red Antler, that have done all sorts of things at Shopify, that have done merchandising at Wayfair. If you believe that we're going to be able to supercharge your business, let's find a way to get to a path to us owning a majority. And that ends up being structured as, some amount of upfront cash. Sometimes there are people that want to be cashed out entirely, which we're happy to do. Oftentimes what we find is a founder or two would like to cash out a little bit and start to feel a little bit more comfortable that they have a partner behind them. And then we take the rest of the cash and we put it towards growth in the business, as you said. So, we like to do a forward plan for the next 18 months and start to understand what we think we can do from a combined resource perspective. And, usually that looks pretty good. And our case studies thus far with what we've been able to do with the businesses that we've bought, really validate that model.
And are you guys doing anything that looks like a traditional, sort of debt finance PE approach where you're going and buying majority stake and then also, having some sort of a debt infusion also? Or is everything coming from, current, profits, operating profits, and then the investment that you guys are making in the brand?
It's really just the investment that we're making. We do have partners, and one of our focuses as far as really making the business operate efficiently is we do bring in, working capital partners such as, Assembled Brands is a group that we partner with on a few deals now. That really becomes inventory financing and allows the brand level to better operate from a cash flow perspective. But, we are buying these deals with equity capital, not looking to sort of debt finance.
Okay. And actually, just for folks that don't really understand sort of that inventory financing side, or maybe haven't dived into that, can you sort of explain how that works a little bit?
Sure. So, you have the traditional merchant financing, old school players that would back inventory and would give you a line of credit. So let's say you have, $10 million of inventory sitting on your books. You could be selling candles. You could be selling silicone rings. The traditional lenders would say, we'll give you credit for, let's say, 50% of that inventory at cost. So they would basically give you a line of credit for $5 million that you could then use to go to your supplier and put it in purchase orders, buy product, etc. It really helps manage the seasonality of the business because if you're coming out of free cash flow to finance those inventory buys, that can be quite punitive, based on the timing and how things work out. So what we like about new age partners, as we call them, groups like Assembled Brands, they really understand the e-commerce side of the business, and they understand that I'm buying a whole lot of candles and they're going to sit in my warehouse, but that my .com business is very healthy and those candles are going to move. They don't need to see a PO from Amazon or a PO from Bloomingdale's. They can get comfortable with the online sales and our momentum as well. So same idea, a little bit better on the thinking that they apply to how that works, but it becomes a critical portion of the overall business that I think a lot of entrepreneurs, either don't have the background or don't have the people, and they don't really do an efficient job at that piece of the puzzle. So when we come in, it's also something that we can clean up pretty quickly.
So first off, that was really helpful. Let's sort of shift gears a little bit, because I want to talk a little bit about how you guys approach, let's call it like the first 12 to 18 months, right? So you've identified a brand, it has strong brand equity, maybe a first mover, in the price point that's, under $100 AOV. They've seen some momentum and traction, over the $5 million revenue mark. What do you guys do first? What does the first 12 to 18 months look like, after you've stepped in and acquired a brand?
Yeah, I think during the M&A process, we do what we all pre and a post analysis. So what we're really looking at is what are the business fundamentals today, looking through all the data points, looking through the Shopify data, all the key KPIs, the trending, Google Analytics, etc. So we can get a pretty good idea, is the business going up or down or sideways? And regardless of up or down or sideways, we then make an assumption of the post-acquisition. What can we do with it, right? What have we seen in this channel? What can we apply to Amazon with silicone rings, right, based on our previous experiences? Once we've done that, that's what gets us comfortable to actually move forward and acquire the deal. Because sometimes, let's use one example, if the conversion rate of a target asset website is extraordinarily low, right? That's fine. That's a data point. If we feel like we can jump in and fix that dramatically, pretty quickly, that actually becomes an advantage for us, right? So we try to really look at it holistically, and a business that's underperforming is not necessarily unattractive for an operating group like ourselves. So post-acquisition, it really comes down to the first 90 days of full-on integration. So how are the teams talking together? Communication, planning, Slack channels, Dropbox, all the things that you would imagine that we would want our teams connecting on. And then it gets into a full, annual planning. And we do planning from a brand level and also from a channel level. So brand level really is a roll-up of the channels. And the channels for us are the direct e-commerce as one, the Amazon channel as two, wholesale and wholesale partners as three, and then four, we really categorize as other. And other could be international, could be platforms like Fair that I mentioned. And what we end up having is one person, either at the brand level or at the win level, depending on where the talent is in that particular case, that puts forward a plan to operate in that channel and have a profitable growth year in that channel, including all the details that you'd expect to fall out of that. So we literally just went through this. It's fresh in mind for me across all the brands. And what you start to see is, let's say Facebook and Instagram as a channel are getting more competitive or getting more expensive. So whoever's managing that direct channel across the various brands, needs to know that, needs to be ahead of that, needs to plan against that, and needs to start finding some other solutions. So maybe that's, streaming platforms, maybe that's podcasts. There's a lot of different buckets you can start to tap, but, we're the opposite of kind of run the ads and see how they do. We try to really be ahead of it. And if we're seeing price sensitivity and pressure in certain channels, we try to really be ahead of that from a planning perspective.
So it sounds like, for every brand, it's a little bit different, right? You sort of have to sort of assess the strengths and weaknesses of the brand you've acquired, and then you put together the plan, accordingly, to what the opportunities are, right? To do that, you've got to have a pretty diversified team, right? So let's sort of shift gears a little bit, and let's talk about, how do you actually execute the plan, right? Is that being executed on the brand level, the team still in place, or are you guys at Win as operators actually operating these brands and running all of the strategy and running, like, for example, the Facebook campaigns or running the Amazon channel? How does that sort of allocation of work, move across brand versus you guys?
Sure. So it's definitely, in some ways, case by case. We deploy what's called a classic, matrix structure. So we have 15 people sitting in specific seats at the Win level that are operational experts at what they do. As an example, there's a head of customer service. As an example, there's a head of creative, which are creative director. So these folks sit at the Win level, and then that entire team supports, any of our brands. And I think one of the best things about going and acquiring majority interest in these brands is you end up finding really unique and amazing talent at the brand level that then becomes, part of us and part of the community. So it is case by case. It is also a little bit dependent on where the brand started, where they got to. That's usually a product of where their strengths lie. So, what I found when I was on the agency side of the business previous to this platform, you would see companies that had an incredible product innovation team, or that had a really good hack when it came to customer acquisition and marketing. Right. But the reality is, where I got to in my mind is, in order for these brands to be successful, they really need a qualified body in all of these 15 seats, right? Like, if I need it, they all need it. And if they don't have it, then they're just having someone double time and probably do a bad job at the position that they haven't hired for. So I think, part of me getting to this place and operating this model was logical in the fact that it's not rational to think that two, founders are going to be able to do these 15 things themselves. And usually, when you're hiring a team in Nashville or hiring a team in Austin, or wherever these groups are that we end up partnering with, they hire the best that they can, and they get to a great level of success doing 20 and 30 million in revenue. But sometimes they start to plateau, and they need additional kind of firepower and support. And we kind of call that our bench, right? Like, call in the bench and allow these folks to come and help you on the next phase of growth. So it's a mix. We try to do a top-down approach of really understanding all the areas of the business, and then qualifying the talent on the brand level, and really leaning into where their strengths are.
And what are those 15 positions? Who are the 15 positions you have, as part of your bench? What's sort of that big value and that you guys bring when you bring a brand on? Who are those 15 people that you guys can inject into the business?
Yes, it's literally head of ops, our COO. It's our head of customer service. It's our creative director that runs our design team. It's our head of paid marketing. It's our head of UX and web design. It's our head of merchandising. You kind of go all the way down through the list of literally what are the functions that you need to run a business, including finance, legal, bookkeeping, all these things that people don't really want to focus on. But I think, something that's sometimes missed when I say a shared service platform, they say, oh, well, that's great. You do like the books and the legal for these companies. And yes, we do, but there's actually so much more than that, because we wanted to have a team that's actually been, in the trenches and operating on these consumer product companies, and understand these, different challenges that we're going to have to go through. So when we buy a business, we're also comfortable that we can step in and manage, all of those functions absent the team, but we want to keep the team. If we can keep an incredible 10 or 20 or 30 people at the brand level that are truly talented, it just makes for a stronger brand and a better outcome for both sides.
Hey crew, just a quick interruption to ask if you like what you are hearing and want more. Perhaps even a weekly digest of what's working today in the world of e-commerce. Every week, our team of strategists compile a single email with growth strategies and operations tactics gleaned from our work with and analysis of today's top performing brands. Think of it as the brand operator's cheat sheet to keep you ahead of the curve and ahead of the competition. Just head over to thecommercelab.com. That's thecommercelab.com to sign up. Is it your belief that, so like the brands you're acquiring are the brands that, let's say, have hit that sort of $5 to $10 million range? They hit the main criteria that you're looking for. Is it not that they don't have the ability to scale? Is that they just don't have the right people on board? Is that really the limiting factor, and where you guys step in and provide the value?
Listen, I think the outcome of all of these product-driven brands comes down to two things: how great the product and the brand is, how special and unique that proposition is, and then the talent and the team that's behind it, right? So you don't know what you don't know. I've always been a big believer in that.
Agreed.
And I literally, through investing and then having the agency, I saw these businesses that really should have taken off like rocket ships, but that didn't have a key resource internally, and that held them back in a very dramatic way, right? So it's also, I'm finding more and more that most of these entrepreneurs that start a candle company or start a ring business or start a clothing line, they're entrepreneurial by nature, right? So that ability to get from 5 to 25 is really what they had their vision set out to do, and they got there, right? And they may not have the best person focused on their capital structure, how to finance the business. They may not have an incredible product sourcing expert that we have here that can double their gross margins, right? So there's things that they just haven't gotten to. I don't think that's a fault of theirs. I just think it's a bandwidth issue. Right. Great example. A lot of companies that we meet and a few that we've now partnered with, they literally say, when I sit down to them, I'm like, hey, listen, this seems like a product that would really move on Amazon. What does your Amazon business look like? And they say, listen, I've been so busy managing my .com, I just haven't gotten to Amazon. I haven't gotten there. I haven't had the bandwidth. I don't have the person, right? So they just can't get to some of those things that when you have a larger team, you can really start to put some effort on it.
So I love that. I love this idea that, because you're absolutely right. When it comes to the entrepreneur, there is a bandwidth issue, no matter how good you are. And at a certain point, you don't know what you don't know. So the ability to, you guys have the right team in place. So you guys actually have these, this bench that you can employ that are experts in each space. But you also, as you expand the group, you also get the ability to sort of cross-reference, right? You can sort of exchange playbooks and this ability to look at what's working in one brand and then apply it to another. So not only just having the right sort of members, but you're also having the right community. So you can actually leverage each other's strengths across brands, right?
Exactly. And then you start to get some operational leverage as well,
right,
which you just would never get at a single brand. So, we can sign master service agreements with our 3PL partners and get reduced rates. We can do that with any number of Shopify apps, right? We can do that with any, internal, external kind of paid marketing partners that we have. So any line item that you would see as an expense on the business, chances are, if you're able to come to the table with 4, 5, 6 brands, you start to get a lot of pricing. And if you're a single brand and you're trying to maintain a relationship with a top tier partner in the space, you literally just don't have any leverage at all. Whatever price they tell you need to pay for email marketing or review marketing, you got to pay it, right? Because there's not a lot of other good options. You know who the best player is. You know that their rack card rates are going up year over year, and you got to pay it. So if you can have a situation on a platform scale that you can get some of those synergies, I think that's important over time as well, because every dollar matters in this business. And the way that these product businesses are set up, we look for businesses that are north of 60% gross margin from a product perspective. Some of them are north of 90%. But any way you slice it, if you can save some capital on some of these traditional OpEx costs, it means a lot. And, our focus is running each of these brands profitable as we grow them, which, by the way, is a little bit different as well. I mean, especially on the investment side of the direct commerce business, tons of these groups have taken on a ton of capital, and they're growing in a very different way than we are. We are on one extreme side of that spectrum, which is we believe you can grow these businesses rationally and profitably over time. And if you can do that, then you can really control your own destiny.
And is the idea to buy and hold forever? Or do you guys have plans to sell brands? What's the long-term model look like?
Yeah, I think this question comes up a lot for us. Our stated goal is to grow and to sell the platform. So if you looked at the 5-year vision moving forward, we are focused on acquiring 5 new brands per year and integrating those brands into the platform, running them hopefully a little bit more efficiently than they were running previous to our involvement, keeping them all profitable. And you end up with a really incredible community and portfolio of brands that are all made up of special products, right? And I think that's interesting for a lot of strategic buyers to come in. I think if we are profitable enough and disciplined enough, profits are always interesting to a lot of buyers. But I would say, we have been approached early days on some of our brands on a one-off basis. And if we had a strategic that was uniquely excited in just one of our brands, we certainly would consider an exit along the way.
Okay. So I think that's a good segue into valuations and talking about how you think about valuing companies in this age that we're in right now, this direct commerce age, but how it's evolved a lot over the last 5 years, right? And so we kind of started the conversation sort of mentioning things that are going on in the market right now, things like the Casper, potential IPO and the S1 that's out. And sort of looking at how some of these major, incredibly financed brands are, operating incredibly unprofitably. And I think it's going to be very interesting to see how those play out. But obviously your mindset is very different, right? You guys want to operate profitably. You want to grow profitably. So when you think about how you value brands, right? When you're valuing a brand to do a deal, or when you're thinking about sort of the long term of eventually selling the holding co, how do you think about how you value these businesses? Is it a multiple of revenue? Is it a multiple of EBITDA? Kind of talk me through, your philosophy there.
Yeah, I think you would put us in the value investor kind of category. For entrepreneurs that are running a $5 or $10 or $25 million business, if you were to take the ideal number in their mind that they were looking to sell for, we're probably not going to meet that bid as far as the enterprise value that we come in at. But what we do is say, listen, we would love to come in and buy 70% of this business, and we'd love for you to stay in collectively for the other 30%. And we believe that with us partnering with you in the next 5 years, we can grow this business, 10x and profitably. So if you were to do the net math on where the entrepreneurs end up, I could make a very strong argument for a lot better outcome. And sometimes, if you have a company that is really a rocket ship out of the gate and kind of going more the traditional venture route of funding, we might not be the best partner for them. They might think that they can be $1 billion standalone business, and I would say for those businesses that are really tracking that way and that can do that on their own, that's a great model and a great outcome if you can get there. But I think the key with us is, we're not just a financial sponsor. We're not just coming in with cash. We're not coming in with cash to try to, milk your business for the next 5 years and then shut it down. We are truly operators who believe, like you with these founders, that these businesses can be bigger than they are today, and that with our help, we can get there a lot faster. I also find, there's anyone that's kind of been in this space and has gone through the battles. I like to say, even for me with this platform, I don't plan on this being my last endeavor in life. I think I'm going to do a great thing here. And I think we're going to have a lot of amazing brands, and at some day there'll be an outcome. But then it's on to the next, right? So if you've created an incredible, men's pants brand that's doing 25 million, by partnering with us and ultimately getting to that exit, then you can start the next chapter, the next great brand that you've probably already conceptualized.
No, it's very cool. And I'll sort of ask the question because I get asked this question all the time, and I see it pop up all the time, whether it's on the Twitter sphere or just in other DTC channels. If a brand came to you and asked, "Hey, look, generally speaking, we're doing 25 million in revenue. We've got a 15%, or 10%, EBITDA margin. What type of multiple do you believe that business should be able to sell for?"
I would say it's dependent on growth, and it's dependent on sizing, right? So, our internal mandate is to maintain a north of 20% growth rate per brand per year. I think that's important, and I've been through a couple sales processes, and having that forward momentum kind of gets you and justifies a better multiple. I would say when it comes to sizing, there's not a big market for exits for companies that are sub 25 million in revenue, right? So if you're not there yet, it's a fairly illiquid market. The reason that we can get uniquely excited about assets that are between 5 and 25 million and, maybe marginally positive and profitable, maybe considerably profitable, maybe losing a little bit of money is, we can come in and we have conviction that we can take that company to a north of $25 million business with the growth rates that are required, with the profitability that's required to ultimately exit. I think once you get there, you could look at a 2x revenue exit as kind of a target. I think there have been exits like Dollar Shave at 4x projected revenue. That's obviously on the high end of the spectrum. If you want to get conservative, you could say closer to 1x on the revenue side. But I think a lot of that is dictated by, how profitable is the business. If you start to look at a multiple of EBIT versus a multiple of revenue, it kind of crosses over, somewhere in the middle. But you could easily get 10x EBIT or more for a business in a space that's unique and growing and profitable.
Okay. In the way that you think about the holding co and your sort of exit opportunities at the end, does that go to another holding company? Does that go to a larger, CPG brand, like something like a P&G? Like what's, who's the ultimate, potential target for what you guys are doing at Win?
Yeah, listen, I think it's going to be super interesting. I think that if you're profitable enough, there's always a path to sell to private equity, right? So that's one option. I think if you are big enough and things are trending in the right direction, this sounds ambitious to say at our scale, but I do see an opportunity here for an IPO of the platform with the underlying brands being the backup and kind of the substance that gets you to your overall revenue and profitability. But I also would say, we've seen some strategics make acquisitions in this space. Let's take one example of Walmart. I don't think Walmart was wrong when they acquired Jet and they acquired Bonobos and several other assets. We've seen that start to unwind a little bit, post-acquisition. I think the reason for that is, they ended up picking up assets that were, losing money and in some cases losing a considerable amount of money. And, Walmart, from what I understand of them, their DNA has always been about making money. And, there's a little bit of I feel like a conflict with that. So I don't think it was necessarily a great fit. But I do think if you look at other retailers, picking up a basket of brands that are all special and unique in their own way, that's working, that's profitable with a team that knows how to operate the online business and some of the other channels. If you take that and apply it to the footprint of a mass retailer where those products make sense, I can make a good case where that makes sense as well. And there's, a dozen of those retailers out there, some that are doing better than others. But I do think, a lot of those retailers are going to have to look toward innovation to continue to grow their businesses.
Yeah, I think that's fascinating. I think it sounds like there's a couple interesting routes you guys could go, and I'm pretty excited to see what you guys do with it. I think it's a very, very cool model. So let's sort of backtrack a little bit, because I do want to talk a little bit about your background. We sort of skirted over it a little bit. I know you were a co-founder for BVXL, which was, I think at the time, or at least a couple of years ago, one of the fastest growing Shopify, or the fastest Shopify agency in the market. Would love to hear kind of your transition. How did you go from sort of the agency side to what's now sort of the holding co? What did that transition look like, and sort of what enabled you to do so?
Sure. So even back before BVXL, I worked for a guy by the name of Chris Birch at Birch Creative Capital, family office here in New York. He and his wife at the time, Tori, were the co-founders of the Tory Birch fashion business. I worked for Chris directly for 7 years. The last 5 years of that, I was doing investments for him on his family office platform. So really broad experience investing from $50,000 checks to $50 million checks, depending on what we're looking at. And beyond that, it was a really full stack experience where I would get sent to China to figure out sourcing for a company that we were either incubating or looking at as an investment. So good experience there, broad experience. I wanted to try something new, and I really wanted to do something on my own. So I had met Dylan Whitman, my co-founder at BVXL, while I was with Chris, and we had done a few investments together, and really bright guy and someone that I was excited to partner with. So decided to break out, decided to start a company. All we knew at the time was we wanted to start a company that could help consumer businesses grow. And what that quickly turned into was a Shopify-focused agency that did design and dev. And then we had a healthy retainer business of companies that would sign a retainer for additional design and dev or paid marketing services or optimization services. So we timed it really, fortunately, in retrospect. I mean, we were early days and one of the only Shopify Plus agencies that were looked at as someone that could take on a key account in those early days. So we were able to work with everyone from Kylie Cosmetics to MVMT Watches, Mizzen and Main, Boll & Branch, Untuckit. But we also worked with P&G and Red Bull. And what I really saw was we had tons of clients. So we had hundreds of clients. This was not an agency where we signed Sony as the AOR and made a big amount of money from them. We were really working with a lot of small accounts. And this gave me perspective on the consumer market, and also kind of opened my eyes up to the long tail of the Shopify community. There's now over 1 million merchants on the Shopify platform, and I got to see a lot of them. So, we built that business up to, north of 100 people, became, frankly, a little bit bigger business than we anticipated. And we were able to sell that business to a private equity firm in August of 2018. And I'd had the idea to set up this shared service platform while I was working on the BVXL platform, and started actively recruiting some key members, started raising some capital. Chris Birch and some others provided our seed funding to get moving. And fast forward, we have a pretty good team built out here that I'm proud of, that we're adding to every day. We bought 4 businesses that you mentioned. We anticipate buying, as I said, 5 this year and going forward. And, it's a fun place to be because I get to, sit down with the CEOs, understand what's working and what's not, try to make the case to them that by joining us as part of this community, we can actually be stronger together and I can help them grow. But at the same time, firsthand, I can celebrate entrepreneurship and everything that comes along with it. I mean, with BVXL, we ended up in a really good place, but it wasn't always that way. I mean, we had months where we almost went out of business, couldn't cover payroll. I mean, things were rocky in the early days. So just having that experience and having gone through it myself, gives that to when I sit down with the CEO and I can really kind of understand where they're at.
And why a holding co? What was it about the prior experience, whether it be at BVA or speaking and dealing with these other DTC brands? Why was the holding co the idea you wanted to pursue next? What was the opportunity there that you saw that nobody else was doing?
Yeah, I think it was the ability to create a team that had functional skill sets in all of the operational areas that I felt were really required to make these businesses succeed. The holding company structure really just became the mechanism by which we could employ that shared service team and then go out and find awesome brands as these subcos that plug into that team. So I think, the structure is more of a function of what I saw as a fit in the market. Like it made a lot of logical sense to me that these brands could operate better as part of a larger infrastructure, a larger platform, have some of the support behind them. And you match that with the fact that, you don't have to do it on your own. There's no big ribbon or big awards for, exiting yourself after 5 or 10 years. If you are able to create special product and hopefully continue to sell that product to customers that love your brand. Like I'm a guy that I read the reviews every single day across our brands. I love reading the reviews, good and bad. Bad you learn from, good. It's always good to see why people and customers love the products. But you don't have to do it on your own. So if I could create a situation where we could prop up some of these brands, and as I said, create a community of, call it, independent brands that are not Walmart, are not Amazon, or not the dollar store. Doesn't mean we can't sell on Amazon, but I want to maintain, the ability for these independent branded products and consumer brands to actually do well.
That's awesome. No, I love that. So, and Kyle, we'll sort of move towards wrapping up here because I know it's later on a Friday and you're on the East Coast. But what I want to do and where I want to take this at the very end is I want to get some of your perspectives on where the market's going. We've seen this thing called D2C, right? Direct to consumer. This wave that started over the last 5 to 10 years. It started as a trickle and it's turned into a tsunami. It feels like there's a new brand popping up every other day. Where do you see this going? Do you see the pace maintaining at the level it's maintaining now? Do you see it starting to slow down? And obviously you guys have a large stake in this market and in wanting to see more brands pop up and ultimately kind of pulling them into your ecosystem, your community, and your holding company. But just given at the rate that we've seen this growth, how do you predict it going over the next 5 years?
That's a great question. Listen, I think it's never been easier to start a brand, right? In the last decade, we've had Shopify continue to grow their platform. I'm obviously a big fan of theirs. And you have every other kind of, they call picks and shovels business that sits in between, functional businesses that allow, a single entrepreneur to stand up a brand, almost overnight. So the challenge becomes scale. And I think scale, as we talked about earlier, is dictated by, how special that product and how efficient the team is at operating that product. So my belief is if you have a special product and you're selling at a price point that makes sense, and again, that's why I kind of stay away from, trend-driven or high fashion. It's just not my background, not my skill set. I think these companies are going to do fine. And what you don't want to do is put too much pressure on them being too big. I own Homesick. I bought it from BuzzFeed in 2018. I think Homesick can easily be a $100 million business, and we're tracking on our way to get there. I don't believe, and I don't frankly want to take Homesick to $1 billion business, right? That's not my ambition. And I think in order to get to that size, and this is something that I think you've probably seen in a lot of these, larger consumer companies, you start off with one product that makes a lot of sense. And if you're really solving for size, all of a sudden you need to get into 5 and 6 and 10 other products that start to make less sense, right? And to me, it's almost a classic, and this is in no way beating up these guys because I actually am big fans of what they've done, but let's take Bonobos. Bonobos was a tremendous pants business. And I remember when, myself, anyone that I knew in New York, the best pants, the colorful pockets. great business. Definitely could have been $100 million pants business, leader in pants, throwing off 10, 15, 20 million in EBIT. Instead of going that track, they raised a ton more money and they tried to grow it into $1 billion business. And frankly, what they ended up with was, J. Crew 2, right? And, J. Crew 1 was not doing tremendously well in the market. So I'm not sure the market wants a J. Crew 2. So I think as you try to force scale on these product businesses, you run into challenges. But I think if you can avoid that and keep the sanctity of the brand and what's special about the product, I think there's tremendous opportunity over the next, 3 to 5 years.
And more specifically, like closer to home, you guys have done 4 acquisitions now. What have you learned after those 4 acquisitions that are going to sort of change the way you guys approach acquisitions in the future? Is there anything you guys have learned sort of just kind of after these first few that are sort of changing the model or changing what you're looking for?
Yeah, it's a great question. Yes, and I think that Amazon is a beast that you really need to have a good handle on harnessing. We are not a DTC brand that avoids Amazon. I know that there are some that do. I love the channel. It's a lot of eyeballs. It's a big pipe that I can plug into. I think understanding the optics of, Amazon growth and Amazon growth potential versus the other channels, direct e-commerce and wholesale. You really have to look at all 3 or call it 4 pretty clearly, and the trajectory and the trending in that specific vertical, silicone rings or scented candles. You got to look at least from our perspective, the cross-channel growth and that potential. And that is where you're able to see, do I have conviction that this is a north of $25 million revenue business and profitable in the next, 18 to 24 months is how we stack it up. And really understanding the macro trends. Some of these channels are getting more expensive. Some of these channels have pretty obvious risk. And, making sure you have real operators that have a deep, deep level of knowledge that you're at least going to be as good or better than most of the peer set as far as execution.
That's awesome. So Kyle, this was a real pleasure, man. This was incredibly informative. And I think everybody listening is going to get a ton of value out of this. So I want to thank you for taking the hour on a Friday, so afternoon, evening, and breaking this down for us. I think this was incredible.
Awesome. Really enjoyed it. Thank you so much for having me. And I appreciate the time as well.
Hey crew, it's Alan Bird again. And real quick before you go, would you like a weekly digest of what's working today in the world of consumer-facing e-commerce? Every week, our team of strategists compile a single email with growth strategies and operations tactics that help you stay ahead of the curve and ahead of the competition. Think of it as the brand operator's cheat sheet. Just head over to thecommercelab.com to sign up.